When buying BRR property deals, should you be buying it in a limited company or your personal name? Well, the reason there's a debate around this is because in April 2017, George Osborne, the then Chancellor, announced Section 24, which was the inability to offset your mortgage against your tax as a runnable cost if you're a high rate taxpayer. So this really changed the landscape of what vehicle you purchase your properties in. So in this video, what we're going to do is we're going to go over two examples. We're going to go over example in a limited company, personal name, and the difference if you're a high rate taxpayer. If you are a low rate taxpayer and you have no intentions of becoming a high rate taxpayer, you get a 20% credit and you're probably better off in your personal name because the running costs, the interest rates and everything is cheaper in your personal name. But if you're a high rate taxpayer, you want to watch this now and see the difference between the two. So BRR, what is BRR? Buy, refurbish, refinance. If you don't know what that is, watch this video here. It explains exactly what it is. But this is the most efficient way to build out your portfolio. But when building out your portfolio, if you're not tax efficient, then it defeats the object. So myself, personally, I buy it in a limited company because I am a high rate taxpayer. I built a portfolio of around 4 million. That's only got about 50 or 48% lending against it. So I've got over 50% equity in that portfolio. But as a consequence, between that and my businesses, push them into high rate tax bracket. So I buy in a limited company, and let's show the example here of why. So let's say I was buying a property for, let's say, 150K. I'm a remote property investor, so no, I can't buy these in the south for 150, but in the north you can buy them in Wales and places like that. On a property for 150, you can expect probably around 850 conservatively rent, probably more, but we'll go on the lower end. A mortgage on something that is 75% of 150 is going to be around £435 per month. That is an average. Don't forget, like, this will fluctuate depending on your rates and your personal circumstances. But that would leave us with a 415 profit pre-tax or pre-running cost profits. I'm not going to add the running cost because that can fluctuate. You could pay different percentage for management. You can have different repairs depending what you've done to the property, etc. So we'll just keep it simple. The same principles count. I'm just not adding those bits in so it doesn't overcomplicate it. Everybody gets a 22% relief. So the 20% relief on this is going to be £87. And my income tax at 40% is going to be 340. Don't forget, my income tax is calculated off the overall turnover. The difference when you're not a high rate taxpayer or in a limited company is it's based off of your pre-tax profit. So that means I paid £253 in tax, leaving a net profit of £162. Now let's compare this to buying in a limited company. Obviously the rent is going to be the same. The mortgage is going to be slightly more because in a limited company you do pay more mortgage. Again, this is the pros and cons of this. Limited company running costs, solicitor fees, accountancy fees, brokerage fees, everything tends to be more. But let's still compare this. So the mortgage is going to be £502 roughly, give or take, depending on your circumstances. That will leave us with a pre-tax profit of around 348. Oh, mind that. 348. Corporation tax is taxed between 19% and 25% depending on your personal circumstances, but on 19%, which most of you will be. So this then will reduce this tax bill over here down to £66. This will then leave us with a net profit of £282. Clearly seeing why I invest in a limited company now, not a personal name. As I said, there's a lot to consider. I'm not a tax advisor. I'm just sharing my knowledge and my limited means of being able to share this with you. Please go and check this out with a proper professional and advisor. Don't take this as tax advice. It's just sharing the understanding of it. And no doubtly, I may have got something slightly off or the numbers are not bang on, but the principle behind this is correct. But you've got to consider, are you better off in a personal name or not? The big difference is whether or not you're a high rate taxpayer and how much money you want to earn in the long run. Because what you got to consider, what I thought initially was, okay, if I have properties in my personal name up to the £52,000 tax rate and then I take a wage from my company afterwards, it doesn't work like that. If I take 50 grand wage from my company, basically what happens is that gets taxed in the lower bracket first, and the properties in your personal name get taxed second. So it pushes all those into higher rate bracket of this. So if you want to earn above 50k, theoretically, in most cases, you want to be personal, meaning a limited company. Or there is some exception to this. Maybe you've got husband and wife, you're utilising both of your allowances, you split it across the two. There is a circumstance and an argument for that. Or you want to live under 50k per year. But make sure you get the right advice, as I said. If wondering how you can find remote locations like I did to buy properties between around 70 to 150k, and that's really the only way you can do single let properties now. If they're under 150k, make sure you watch this video here to pick your golden one location. If you're still here, smash that subscribe button, hit the like button, really helps the channel. Share it out to somebody if you think they'll find this valuable. My wife's live my terms. My mission is to help as many people live on their terms, using financial education as a vehicle to do that. So please share this out. But remember, if you don't evolve your ideas, you never live on your own terms. So evolve your ideas, live on your own terms, and have an amazing day.